parts to the GDP: manufacturing, agriculture, services. Services growing, manufacturing, we have been debilitated. Agriculture remains a fairly vulnerable piece and probably more vulnerable because of climate change today. But this has an important contribution to make, and it is not just from contribution to GDP perspective, but a lot of second and third order effects. The fact that it can increase jobs, the fact that it can increase individuals of incomes of individuals and spur consumption. It can propel growth, it can reduce imports and therefore minimize the pressure on foreign exchange. All of these important aspects to manufacturing. And now the administration has clearly recognized that this is a part of the economy that we cannot ignore. And the policy directive has been to strengthen manufacturing. And of course, we have tailwinds now. The macro geopolitical situation is also in our favor. There is this China +1, which has been playing out for more than 5 years now, Europe +1, and our own policies in terms of Atmanirbhar and all of that. So one, from the area that manufacturing can alter the course of Indian economy. And second, how does this really get represented in the stock market? What are the wealth creation opportunities that we can really benefit from? To discuss this, let me lead with Vikas. Vikas, tell us, how do you think the big picture really looks? If you just stretch out 5 years from now, let's start with 3 to 5 years from now, how do you see this manufacturing push really altering the complexion of the Indian economy? And of course, we'll take it up. Take it.
Manufacturing has been one of the biggest pain point of Indian economy for many years. I think last probably a little bit push was given in manufacturing was early 90s or post liberalization, the mid 90s we saw some. But other than that, I think manufacturing has been a very big pain point. We never invested anything in we have a large population, so most of the consumption now kind of depends on the imports, especially from China. And of course, the globalization kind of added to it because Chinese produce goods cheap, and that made all the more things worse for Indian economy and Indian manufacturers. I think, and that reduced our manufacturing share of GDP to less than 15%. And that has kind of remained there static for last 20 years, almost there. And there's an acute need to which government has felt, this government has been saying for some time, but I think in last 2 years, concrete measures have been taken to address this. And government is, of course, targeting to take this share to 25%, which is not easy, which is very sort of aggressive task and tall ask. Of course, nothing is impossible. But even if I were to take, let's say, for time being, a mid number of 20%, right, which is fairly achievable. But that itself means that our Indian manufacturing GDP, which is thereabouts of $450 billion to $500 billion, will reach to almost close to $1 trillion, which means we'll be doubling our manufacturing GDP. And that has severe implications, specifically on 3 counts. Number one, I think when you add this kind of manufacturing GDP, you will add serious amount of jobs. So to give you a sort of context on that, in manufacturing, if you add $500 billion of GDP, the wage ratio is roughly about 10%. So you will add $50 billion of salary spent into the economy, both blue collar and white collar, and that will have a huge multiplier impact. MNREGA, which was a huge demand booster when it was introduced in 2009, the annual allocation to that has been around $10 billion. So you are basically talking about this manufacturing shift, if it happens, 5 times of MNREGA coming only from this one sort of figure, which is I'm talking about 20% mark. So that is huge multiplier impact. Second, whenever you do manufacturing, you need huge amount of capex. So if you add another $500 billion of GDP, you will need around $150 to $200 billion of capital investment. We have been wanting to have that kicking off for a long time, and I think I'm glad that it has begun, and it will only kind of get better from here. And then lastly, I think the point which you touched upon, that as we import from outside, it obviously puts pressure on our rupee, on our currency reserves, and we import more and we make it up with the capital account sort of flows. But if we reduce our import, our dependence on capital account goes down. And I feel that if we address our manufacturing right, along with few of the things which are happening on the IT sector growth and all, this has the potential to kind of wipe out our current account deficit in the next 5-7 years time. So so it basically can lead to our structural repair of the country. So at one level, you are addressing job issue, investment cycle, and current deficit, and all these things can have a very, very far-reaching impact. If can you imagine if our rupee stops depreciating, what kind of implication it can have on the whole economic profile of the country? So I think this is just, of course, it will take time. It will happen. It is not going to happen overnight. But I think this initiative or this big trend has a huge implication for the economy in general, and of course, it will invariably lead to wealth creation cycle in the market.